Congratulations. If you are hearing my voice right now and you are still holding your physical silver, you have already won a battle that most people never even realized was being fought. For months, you have been subjected to one of the most aggressive psychological operations in the history of financial markets. The price collapsed without explanation. The headlines mocked you. The experts laughed. The commentators told you the silver squeeze was dead, finished, buried. And yet, you are still here. That matters more than you understand. Because this was never just about price. It was about conviction. It was about forcing you to doubt yourself long enough to make you sell. Ladies and gentlemen, Asian guy here, known as John A.G.A. from Currency Archive. I have seen the comments. I have read the attacks. I have seen people saying, you were wrong, the price dropped, you promised a breakout, and all we got was a red candle. And to those people, I say this clearly. You were watching the waves, not the tide. You were staring at a paper illusion designed by banks whose only goal is to shake you loose. You were watching a number on a screen while completely missing the tectonic shift happening underneath the global financial system. They wanted you angry at me. They wanted you angry at the movement. Because anger leads to frustration. Frustration leads to selling. And selling gives them exactly what they need. But the fact that you did not sell is proof that their strategy failed. You held the line. That is not stubbornness. That is victory. Because here's the truth they cannot say out loud. Paper prices lie. Physical reality does not. And everything I am about to show you proves that what we are witnessing is no longer a temporary squeeze. A squeeze implies pressure that eventually releases. What is happening now is something far more dangerous for the financial system. This is a takeover. Starting with the opening bell of 2026, we are watching a hostile takeover of the global silver market. The West is dumping paper. The East is taking the metal. And if you are holding physical silver, you are standing on the winning side of history. Let the critics talk. Let the paper traders cry about stop losses. They are playing a short-term game inside a collapsing system. We are playing for the future of the monetary order itself. And the first piece of evidence, the smoking gun that proves this is a takeover and not just another trade, is something the mainstream media refuses to connect. It lies in the relationship between green energy and geopolitical power. We need to talk about the solar chokehold. For years, you have been told that silver demand is rising because of solar panels. That part is true. But what they never told you is who controls those panels. As of late 2025, over 80% of the global solar panel manufacturing capacity is controlled by China. The United States, Europe, and Japan combined control less than 20%. Now think about the physics of a solar panel. You cannot manufacture one without silver paste. It is not optional. It is the conductor that turns sunlight into electricity. That means whoever controls solar manufacturing controls silver demand. And here is the part they do not want you to think about. If China controls the factories, do you really believe they will allow critical silver supply to leave their borders just because a Western bank smashed the paper price? Of course not. What we are receiving from multiple verified sources on the ground in Shenzhen and Shanghai is clear. China is not just buying silver, they are weaponizing it. Quietly, without press conferences or headlines, they have implemented the strictest export controls we have ever seen. Silver is being kept inside the country. Industrial supply is being locked down. The message to the West is simple. If you want solar panels, you buy them from us. But you are not getting the silver to build your own. This is not a trade policy. This is a resource blockade. And blockades create market bifurcation. You can see it clearly if you know where to look. You do not need insider leaks or secret documents. You just need one number, the Shanghai premium. Right now, physical silver on the Shanghai exchange is trading roughly $7 higher than silver on the New York paper market. $7. In a functioning market, that gap would close within hours. Traders would buy silver in New York, ship it to Shanghai, sell it, and pocket the difference. Free money. But the gap is not closing, it is widening, and that tells you everything. It tells you that the metal either cannot move fast enough or does not exist in the quantities being claimed. It tells you the real price of silver, the price paid by people who actually need the metal, is far higher than the fake price displayed on your trading app. This spread is not noise. It is a smoke alarm. It is screaming that physical metal is draining out of the West, leaving the vaults of London, leaving the vaults of New York, flowing east into the industrial black hole of China. And China is happy to pay the premium because they understand something the paper traders refuse to accept. The paper price is a lie. And while the West plays games with derivatives, the East is accumulating real wealth. When you see the price drop on the screen, do not panic. Understand what is actually happening. Every drop in paper price makes the arbitrage more profitable. Every smash accelerates the drain. It is like discounting food during a famine. The shelves will empty faster. And that is exactly where we are now. But the solar chokehold is only one side of the equation. Because there is another force holding the floor under this market, and it is far more volatile. Fear. And that is where this story gets darker. Because while banks manipulate charts, the real world is catching fire. And that fire is pushing capital into silver whether the banks like it or not. That fire is what we call the war bid. And this is the part of the story the mainstream media absolutely refuses to touch. Because once you understand it, you understand why the price of silver refuses to stay down no matter how violently the banks try to smash it. This market is no longer driven by simple supply and demand. It is driven by fear, by geopolitics, and by survival. We are witnessing a convergence of global crises that we have not seen since the 1970s, and every one of them puts a concrete floor under silver. Look at the energy markets first. For the last 48 hours, reports have confirmed that United States naval assets have tightened their presence around the Venezuelan coast. Tankers are being intercepted. Sanctions are being enforced with an aggression we have not seen in years. The market does not interpret this as routine policy. It interprets it as a flashpoint. Every time a U.S. destroyer stops a tanker in the Caribbean, the risk premium on commodities spikes. Oil spikes, gold spikes, and silver spikes. Because the market prices in the possibility of escalation. And Venezuela is only half the story. At the same time, confirmed reports show coordinated strikes across the oil fields of Nigeria, the largest oil producer in Africa. When you remove Venezuelan heavy crude through a blockade and Nigerian light sweet crude through strikes, you create an energy shock. History is very clear about what happens next. Energy prices rise, inflation accelerates, currencies weaken, and hard assets reprice higher. Silver is directly tied to this because energy is the primary cost input for mining. When diesel costs more, silver costs more. But the deeper issue is monetary fear. Energy shocks destroy purchasing power, they expose debt, and they force capital to seek safety. In moments like this, paper promises die first. A digital currency backed by a government drowning in debt becomes a liability. That is why sovereign wealth funds, family offices, and industrial buyers are accumulating silver right now. Not because they expect a chart pattern to resolve, but because they are preparing for instability. This is why every time the banks smash the paper price to $70, it bounces back almost immediately. It is like trying to hold a beach ball underwater. The moment the pressure is released, it explodes higher. That buoyancy is the war bid. It is the geopolitical floor, and this floor terrifies the banks. In a normal market, they could crush the price to 50 and keep it there for months. But in this market, a move to 50 would trigger panic buying and drain every remaining ounce from the vaults in days. They are trapped. On one side is China hoarding supply through the solar chokehold. On the other side is geopolitical fear driving safe haven demand. They cannot let the price rise because they are short, and they cannot push it down because they will lose their inventory. So when an animal is cornered, it does not play fair. It cheats. It changes the rules of the game. And that is exactly what happened next. Because when supply control and fear fail to shake you out, the only option left is to attack the mechanics of the market itself, not the price. Your ability to hold the position. This brings us to the dirty trick, the nuclear option, the margin nuke. In late December 2025, quietly and without headlines, the exchange raised margin requirements on silver futures. The deposit to hold a standard 5,000-ounce contract jumped from roughly $21,000 to $25,000. To most people, this sounds boring. Technical, harmless. It is not. It is a targeted liquidation weapon. A silver contract at $72 represents $360,000 worth of metal, but traders only put up a fraction of that value as margin. When the exchange suddenly demands 20% more cash overnight, thousands of traders instantly fall into deficit. They receive margin calls, wire money immediately, or be liquidated. Most cannot wire the money, especially during a holiday week, so they are forced to sell. Not because they want to, because the rules changed. That selling drives the price down. That drop triggers more margin calls, more forced selling, a self-reinforcing avalanche of artificial pressure. This is not market behavior. It is engineered, and it was not done for safety. Volatility was low when the margin hike occurred. There was no risk management justification. The only reason to do it was strategic. The banks saw what was coming in January. They knew about China. They knew about energy tensions. They knew buying pressure was building, so they cleared the deck in advance. They flushed weak hands before the real demand arrived. It was calculated, cruel, and perfectly timed. But here's the part that matters most. It is not working. Open interest has not collapsed. Strong hands are absorbing the hit. People are wiring cash, selling other assets, refusing to let go. And for anyone holding physical silver, this entire margin drama is irrelevant. You cannot be margin called on metal in your possession. You have no counterparty risk. The exchange can raise margins to $1 million and it changes nothing. In fact, this manipulation helps you. It keeps the sale sign lit a little longer. It gives you one last window to exchange weakening fiat for hard metal before reality takes over. And that is why they are doing this. You do not deploy a nuclear weapon unless you are losing the conventional war. If the banks had silver, they would deliver it. They would not change the rules to prevent delivery. The margin hike is not about safety. It is about default prevention. It is about stopping you from walking to the vault. And that is the clearest proof yet that the inventory is gone. The margin hike was the weapon, but a weapon does not fire itself. Someone pulled the trigger. Someone gave the order. And to understand what is really happening, you need to look at who is sitting on the other side of this trade. JP Morgan and the swap dealers. While retail traders are watching red candles, these institutions are watching something far more dangerous. Their own extinction. They are trapped in a financial vice, and their only escape route is to trick you into opening the door. This brings us to the smoking gun of the weekend, a research memo released by Morgan Stanley to its high net worth clients. The headline sounds harmless. Commodities rally, overextended. Time to exit. They are advising clients to take profits and step aside. To the untrained ear, this sounds like wisdom. In reality, it is desperation. You need to understand banker language. When a major investment bank tells the public to sell, it does not mean the asset is going down. It means they need liquidity. Markets are zero sum. For every seller, there must be a buyer. If Morgan Stanley wants to buy millions of ounces to cover shorts or position their proprietary desks, they cannot do it openly. Massive buying would explode the price and destroy their entry. So they manufacture sellers. They release bearish research. They scare the herd. They create a liquidity event. They need you to panic sell so they can quietly buy without moving the market. This is the oldest trick on Wall Street, the head fake. If they truly believed silver was going to crash, they would say nothing and simply short it. The fact they are telling you to exit tells you they are desperate to buy. And why are they desperate? Because the banks are sitting on historic short positions. According to the latest positioning data, commercial players are net short hundreds of millions of ounces. Many of these shorts were entered at prices far below current levels. Every dollar silver stays above those levels bleeds them. But the real danger is not mark-to-market losses. It is delivery. If the price stays elevated, longs will stand for delivery, and the banks do not have the metal. If 10,000 contracts demand delivery, that is 50 million ounces. The registered inventory does not exist to cover it, so the banks have two options. Buy physical silver at any price and blow themselves up, or force longs to close for cash before delivery. They are choosing option 2. This is the flush. Margin hikes are the stick. Bearish research is the narrative. Together they create maximum fear. The objective is simple. Smash the price back into the 60s, long enough to cover shorts and escape. They know exactly where retail stop losses sit. Around 71, around 70. The order book is visible to them. They push the price just low enough to trigger stops. Automated selling kicks in, price cascades lower. And who is waiting at the bottom with unlimited buying power? JP Morgan. They scoop up contracts, they cover shorts. And retail is left with realized losses and no silver. This strategy has worked for decades. But here is why this time is different. In the past, the only buyers were speculators. Today, the buyers are industrial giants, sovereign funds, and China. These buyers do not use stop losses. If the price drops, they do not panic. They accelerate buying. What the banks think will be a flush may turn into a brick wall. If they smash the price and it does not collapse, they will have fired their last bullet. They will have exposed their weakness. And that is why this week matters. The banks are projecting confidence, but their actions scream fear. Margin nukes, coordinated narratives, exit memos. These are not signs of strength. They are signs of a system fighting for survival. They are trying to convince you to trade places with them in a burning building. But the fire is already too big, and the door is closing. Now step back, close the charts. Ignore the noise of the opening bell, the flashing candles, the screaming headlines, because what happens on Monday morning is not the point. Whether JP Morgan succeeds in forcing the price briefly to 70, or whether silver breaks above 82.67 is only another skirmish. Those are tactical battles. The war itself has already been decided. The system is breaking, not in some distant future, but right now, in real time. That $7 gap between the paper price in New York and the physical price in Shanghai is not an anomaly, not a glitch, not a temporary inefficiency. It is the death rattle of the legacy financial system. For more than 50 years, the Western financial centers dictated the value of silver through paper markets. New York and London set a number, and the rest of the world obeyed. If they said silver was cheap, it was cheap everywhere. That power is gone. When Shanghai is bidding 80 while New York prints 72, that is not a spread. It is a declaration. It is China telling the world that Western paper prices no longer define reality. The center of gravity has shifted from paper to metal, from promises to possession, from west to east. And this shift forces every investor to make the most important decision of their lifetime: settlement or power. If you hold paper silver, futures contracts, unallocated pool accounts, or ETFs, you do not own silver. You own a claim. You own a promise made by an institution that is already under stress. And promises fail when pressure becomes unbearable. If silver goes vertical, if the price explodes to 100 or 200, do you honestly believe the banks will deliver strategic industrial metal that entire energy systems depend on? They will not. They will cash settle. They will invoke force majeure. They will close your position and wire you dollars at yesterday's price while the metal disappears from the market. You will be rich in numbers and poor in reality. Cash settlement is not a feature. It is default with a smile. It is the system admitting it lost while refusing to pay the winner. But physical silver is different. If you hold the metal in your hand, in your safe, or in a private vault under your control, none of their rules apply to you. There is no margin call. There is no counterparty risk. There is no clause they can trigger to take it away. They cannot settle you in cash for something they do not possess. The metal you hold is sovereignty. It is power. By holding physical, you have exited their casino entirely. You are no longer betting on the game. You own the chips. And when the paper market finally fractures, when price discovery permanently migrates east, you will not be asking what silver is worth. You will be deciding. This is why the manipulation is so violent right now. Every red candle you see is engineered. Every sudden smash is artificial. Every bearish report released at the exact wrong moment is a trap. They are trying to exhaust you emotionally because they cannot defeat you fundamentally. China is locking supply through the solar chokehold. Geopolitical instability is accelerating fear demand. Energy shocks are returning. Inflation is not dead. Vault inventories are bleeding, and Shanghai is setting a rising floor under the market. The destination was never 75. It was never 82. It is a complete repricing of silver based on its true scarcity in a world that cannot function without it. Triple-digit silver is not hype. It is arithmetic. It is what happens when paper lies collide with physical reality. So when volatility hits, remember this: every dip is a gift. Every scare is a signal. Every attempt to push you out is confirmation that you're standing in the right place. Do not trade power for promises. Do not let them buy your future with fear. Watch the spread. Ignore the noise. The system is breaking, and those holding real assets will write what comes next. We are no longer passengers. We are no longer spectators. We are the market now. This is John A.G. from Currency Archive. The analysis is complete. The strategy is clear. The warning has been delivered. The bell is about to ring. I will see you on the other side.